for any given level of risk. And if a portfolio is below the curve, then for the same amount of risk, you can achieve higher returns. The capital market line takes the same thing into account with the inclusion of risk-free assets. The capital market line shows where the capital market line touches is tangent to the efficient frontier is where the most efficient portfolio lies. The portfolio associated with that point maximizes the linear trade-off between risk and return over and above the risk-free rate. And when we apply the modern portfolio theory to our super index, we find that over here the capital market line was constructed by multiplying the Sharpe ratio by the standard deviation of the portfolio plus the risk-free rate. And the risk-free rate is found by averaging 10-year Treasury notes of the past 10 years. The efficiency frontier here was constructed by finding the expected return and standard deviation of portfolios of various weightings between the S&P 500 and the riskless security. The SI index portfolio produces a return well above the capital market line for the same level of risk, which would be impossible by both the market portfolio theory and the efficient market hypothesis. So we can say that the market is not really efficient. Why doesn't everyone follow the value investing? Because making money on cheap stocks is harder than it sounds. Here I have a quote by John Murray Everard. He says that most people aren't cut out for value investing because human nature shrinks from pain. To be a value investor, it isn't enough to buy cheap stocks. You have to stick around until the market recognizes their worth. A lot of managers also have institutional constraints as they handle several accounts and they cannot afford to follow this approach. But with the right mindset, despite what most people will think, the odds just might be in your favor. Summit Street Capital Management is an investment partnership in New York. It recently analyzed a group of value investors with long records of high returns and found that even the best underperformed 1/3 to 40% of the time. And this is, most people do not have the mindset to take these losses and sit through such times. In conclusion, one can easily see that Super Investor Index outperforms both the S&P 500 and Russell 2000 in every period. And overall, the cumulative returns were far superior to other indexes. The market is inefficient, and there always be wide discrepancies between price and value in the market. The modern portfolio theory and the efficient market hypothesis have been disproved. Value investing is quite simple if you have the right mindset to be a value investor. Thank you.